Welcome in, welcome in. It is August 12th, right before market open. We are live. We had CPI numbers come out today. They were in line, appears to be have been in line with the projections, and the market is up and down a little bit. So let's take a look at the open positions, and let's just look at the activity from yesterday. And one of the things that I saw yesterday was my call spread that I opened up yesterday closed in the same day as the market dipped, and then opened, and then so it took that profit, and now the market's up. I would expect as we move into today that we'll immediately see on the market open, as it bounces up, some of these QQQ options close. This one is still in the money. We were at a max loss, potential max loss, I guess, from the first time I rolled it. And in this case, let's see, let's go to the order chains on this, and let's just look at the call. I don't know if I can just look at the calls on this. Strategies, vertical. I don't think I can. Thought there was a way to filter that. Well, let's just look at the losses. Open position. So we call this one, we opened it initially for a 74-cent credit, so that's $74. And then we rolled it out to the 19th, August 7th to the 19th, for a 19-cent credit. So what we're looking at there is we've made about just under $100 on that, and it's effectively $1,000 loser overall if we let it go to expiration. Total P&L right now is 400. I think that might be, as we see this market, I really like to defend, but as we see this market keep rolling up, I think this might just be a close for a loss and move on at this point and save the extra 500. I don't know if we can roll far enough out to make it worth our while to defend this, but we'll take a look at that and just see if there's any more information on that. But overall, in the last 30 days, this strategy of mostly put credit spreads has paid off $4,500 in a month, which is really my target on that. So I'm quite good with that. So I'll probably look at closing that today and see where the market is. If it pulls back, it might be worth closing. It might be a little bit more of a loser, but I do expect to see some stuff close when the market pops up. So let's just run through the open positions, and then we'll look at the trades today. Market should be open in about a minute. So this is 30-year bonds, options on a 30-year bond, September expiration on the future. There's our market open. The 30-year expiration on the future, and there's our SpaceX closing and some QQQ closing. See, there I told you we'd have a whole bunch of stuff closed right away. So right here we've got bonds bounced up with this CPI. We've got, let's see, this has been open for 41 days. I've just been carrying this. It still is a good trade. We have 9 days left on that August 21st expiration. So we're just burning money off at this point on theta decay. This is the September, same ZB, but this is the December contract. Denotes ZB 30-year note or 30-year bonds. Z is the month of December. 6 would be the year it expires. So December of 2026 futures. We're trading options on those futures for September 25th. And slowly but surely, those will decay in value. I think we're going to hold around here for the next month. So it's just a matter of time. The 104 is set to expire, set to close at 12, so we're a little bit off from that. And the 105 is set to close at 9. We got a ways to go on that one. Amazon, same thing. We've sold the 260 covered call on Amazon on the 100 shares that I'm holding. It's at 270, so we're a little upside down in that, but that's okay. We're just going to let that expire and get called away probably. Google. Same thing on Google, except we're not in the money. Sold the 370. I own those at 370. They got assigned at 370. So we're just going to let that burn off. And we're going to manage that. When this gets to 21 days out, we'll roll it out and pick up more time. Robinhood sold the naked 75 put. We've got that set to close at 60. It's kind of a wide spread, but that is looking good today. Robinhood is up. We looked at QQQ. We'll come back to QQQ. Silver was up and down. Volatility is kind of spiking on silver right now. And let's look at who projected. Someone just, JP Morgan, okay. JP Morgan projected at $81 for the end of the year. Goldman Sachs, 85 to 100. HSBC, that's a bank, I can't remember which one. 75. And so overall, the projection is that it's going to be up by the end of the year. And so I think that's driving this upward price. That doesn't mean that those same banks, when it goes up, won't short it and push it right back down. But overall, SLV is the silver ETF. It moves slightly behind the price of the spot price on silver or the futures price because it does carry some cash. SpaceX. So I'm holding 200 shares of SpaceX at an average price of $133.56. Sold the 140 call, sold the 130 call. And we're right on track with those. Nothing to do there. And last one is the SPY. Traded that out. It's been open for 6 days. And nothing to really do with that. So no management that I need to do. Let's jump in and look at the QQQ. We do have options buying power, $48,000 available. And as we see, all of the QQQ trades seem to have closed other than our call, which we're right at the money on that. Let's see what it would cost to close that right now. If we want to just close it as a loser, we've earned just under $100, so it's going to cost us $500 to close it. And I think the reality on that is, let's look at the market here. Let's look at the QQQ chart. I'm going to wait. I'm seeing a hard pull back this morning, and I'm going to wait on closing that. I was thinking about closing it right away, but I'm going to wait. Welcome in, everyone. I do see we have live viewers. Thank you very much for being here. If you would, throw in the chat who you are, where you're from, and help me with the algorithm. I know Brent probably has a very great question this morning if he's here, and he'll probably use some acronyms I'll have to figure out. And let's see here. We've got no puts. That looks like the only trade we have working right there. So we're going to start off this morning as this drops down. We're going to we're going to run over here to one standard deviation down, right? And what we've got is our expected move is about 13 to 14 here. And that's that gray bar. And then we're going to run down here to about somewhere between the 16 and 10 delta. And I like to grab divisibles of 5. I'm less aggressive on this. Don't need to be hyper aggressive on this up market that's moving down. But I'm going to trade the 105. And I think what I'm going to do today, let's see what the 105, 185 is. So 105, 185. So that's 2,000 risk. Although it's not showing that. Did I do something wrong? I'm sorry, the 705. 85. Oh, the reason the buying power is because I've got the call on. So and then that's going to pay 99 cents. I want a little bit better than that. Let's see if we're dropping some here. All right. 705, 675 for $1.14, and we're going to trade two of those today. Two of those for $2.24. If it fills. There we go. And we're going to go ahead and immediately set that to close. It was at 204. We're going to set that to close at 50 cents. So if everything goes right in 7 days, we will basically use 3,000 times 2, so 6,000, and make $100. So 1.6% for the week. A little bit lower than we've been getting, but that's okay. It's well within the target range, and that's right where I want to be at. 1% a week is what my target is, and that's where we're at. So, sorry, set that to close. 50 cents. Good till canceled. Done. So that's $100 of potential profit that we're targeting. And let's just look at the watch list and see if there's anything else that I would like to take to trade. AMD is dropping today. Let's see if we can't pick an AMD trade up. Either a 7-day or a 6-week. Let's just take a look. It opened up. So if on my other chart that shows overnight, we crept up overnight, and now we're dropping back as people are taking profit. So the close yesterday would have been 475, and we're at 482 on the extended hours trading. And I am looking at 6 weeks out. And I'm going to trade a 360, 330. So we're going, let's go 360, 340. 24 cents there wide, 40 cents there wide. 250 is the Midland range. So we can get that filled. So a 380, 340. So we're going one standard deviation out right at the 910 delta. I filled immediately. I probably could have made a little bit more on that. And then I'm going to set that to close. So that was at 242, I believe is what we got filled on that. 242. I'm going to set that to close since my target, I'm targeting $100 on the other trade. I'm going to target 105 on this for my 200 for the day. So let's set this to close at 36. So 242 collected now, buy back for 136, $106. That's my target of $200 for the day. Everything's set to close. Chat. Okay. Let me jump into Brent's got a. You like to do the put credit spreads after a pullback. Why is that? Lower risk or higher profit? So two reasons why I like to do the put credit spreads after a pullback. In general, as you're, and let's just, I'm going to do it with, all right, let's do this. So two things, and I'm going to switch to a split screen here. And I'm going to show you the VIX on this, the volatility index, and I'm going to show you the SPY, because that measures against the S&P 500, and I'm going to go to a 4-hour chart on both. Keeping in mind this is slightly delayed, but what we should see, and see how my line on this chart and my line on this chart are going to be at basically the same spot. What we see is as this drops on the VIX, oh, that's because it's not showing me what I want. I want the VIX. There we go, volatility. So what we're going to see is that as we have this pullback, see, it's not showing me any of what I want. No wonder it's that. Okay. As we have this pullback here, you'll notice that the VIX, this is a drop here, and the VIX, the volatility spikes up. And as the VIX goes up here, your volatility drops. When volatility goes up, now let's jump into, and I'm just going to use this. This is your implied volatility rank. The higher your volatility, in theory, the higher your premiums of selling. We're selling premium. Higher volatility means higher premiums. So in a pullback, we're going to get higher premiums, higher volatility. We're going to sell the same thing for the same amount of money for more profit. And then when the market rebounds, because overall, keeping in mind that overall, I'm still bullish on the stuff I'm trading. I'm still bullish on AMD. I don't think AMD is going to nothing. I think AMD is fluctuating. So as AMD drops, the volatility goes up, the contracts are worth more, and I can get in lower. If you wait until something has peaked and sell it, I still sell QQQ every day, even if it's up, but I'd rather sell more when it's down, right? Wait for the pullback, volatility goes up, value becomes worth more, I sell it. Now, even if it stays the same and your volatility drops, your contract becomes worth less and you sell it back. So the idea is then as volatility drops, these contracts lose value, which is good for us because we sold the contract, and then the price goes up or stays the same and we sell it back. So that's why I do look for the pullbacks, and because in general, the pullbacks are going to make you more money. I also don't necessarily want to buy at the top of the market on something. I want to buy as something drops. You're never going to hit the bottom. You're never going to hit the top. But I do tend to I don't want to chase a rush up. I want to get in something when it's down that I think can go back up. And in this case, I don't even necessarily want to own it. I just want to trade the contract on that. And as we see right here, that trade that we made within a few minutes is already up $11. And let's go back and check AMD. So AMD, while it's still up on the 4-hour, right, it's pulled back from this earnings report. And let's look at the 15-minute chart. And we're already seeing that reversal from that low that we just traded. And my guess is it's going to follow this pattern. It's kind of waves. It goes up, curves down, up, curves down, up. That's my guess. And what we'll see here is usually there's going to be a line that it's going to bounce off of. And I don't do a whole bunch of chart analysis, but you'll see kind of this parallel line or close. And what I would expect is bounce off this line and go back up, and then bounce off that line and down and kind of waves up. If you break out of that pattern, then you're looking for for something different. But in this case, I'm not necessarily trading that and trying to buy and time it. I'm just waiting. Okay, we had a pullback. I want AMD. The volatility's high. It's a good entry point for me. And as this moves up and down today, we could very well close this pretty quickly in a day or two. Does that answer the question? So it's not really a lower risk. In fact, as the volatility goes up, the risk goes up some, but that means the premiums go up as well. The reason I do this 6 weeks out is because I'm okay. Like AMD would have to drop $100 to challenge this. And while I'm limiting my risk, at the same time, when AMD was $100 and $200, I didn't get into it, but I had sold puts on it and it skyrocketed up and I missed the up move because I took my profit. So I didn't catch the top of the market. I didn't catch the bottom of the market, but I made money on that. So when we see something depressed, that's kind of the times where we can take a leaps trade. If we have another, tariff thing or a war where the price really plummets, keeping in mind that your volatility goes up, but you can pick up further out contracts if you want to gamble on buying. I really try and stay away from buying contracts alone because my whole goal is to sell people the contracts and collect, as time passes, collect that theta. And right now my theta is right where I want it at $220 a day. My delta's at 205. I've had it higher, I've had it lower. Right now I'm kind of bullish on the market. The only other thing I was going to look at was QQQ is going up. Let's look at this trade here. I think it's time to close this for the loss. And basically just take the $500 loss on that and we're out of that trade. Now I could look at, do I want to trade that again at 745 for the week? And now the market is bouncing up today on this part. So we caught the downswing on QQQ. This morning we grabbed that quick. Let's see where we end up here, and we'll take a few minutes. Normally I'd be done. Take a few minutes, and I think what I'm going to do is go ahead and trade, make it the Iron Condor, go out to this 10 delta, and I will sell the 745, buy back the 755 for a 75-cent credit. So that's another $75 for the day. And then I'm immediately going to set that again, a closing order for 45 cents. It's not a ton of money. We're grabbing an extra $30, $40 with $1,000 risk. So targeting $30 is still targeting a 3% profit on our money. So go ahead and grab that. I think I could be wrong. I think we're going to bounce in here between the 720, 730 for a while. But I'm going to go ahead and grab one of those. It's not any extra buying power, but it is extra risk on. And we're just going to target that risk for 7 days. All right, that is all I've got for today. Those are my trades. In and out of the market in 20 minutes. It's kind of my target is 30 minutes, no more, no less. And not waste my whole day, which I used to do, sit in front of the screen trying to make trades. Are there any questions before I wrap this up? Well, thank you very much, folks, and I will see you guys tomorrow.